I hope my screen is visible to you.
Yes, sir, it is visible.
Okay. So, hello everyone. Welcome to our last week's live session. And in week 12, we like understand the concept of like the different pricing models, like which are used to like evaluate whether a particular opportunity is worth investing or not. Mainly we focused on the most basic model, which we call the capital asset pricing model, and we touched a bit upon like the factor models also and arbitrage pricing. And we will be reviewing that. And if you have any questions regarding this, please let me know. So like first we understand the concept of beta, which is like measure of like how a particular asset or a investment opportunity, or we call it a project. These are like different names, like kind of things in which you are thinking of investing. So a market beta of a particular project, it measures like how it co-varies with the market. And the basic assumption here is like you have full information regarding market, like whatever assets which are available in the market, you have complete access to that. Okay, once you got this beta, how this beta is useful to you. So if a project has a negative beta with respect to the market, what it means, it means that if market goes up, then it will go down. Otherwise, like in vice versa terms, like if market goes down, then this project return would tends to go up. And we can relate the same thing with like in case the beta is positive for a project, then it will be like it will move in the same direction the market is moving. If market goes up, it will go up. If market goes down, it will go down. So why market beta is important? So it is a good measure of like investment risk, like how this investment is contributing towards the overall risk of for an investor, and how you can utilize this. So lower the market beta, better it is in terms of reducing investor risk. So here, like if you have a, so in the class we discuss also like if you have full market access, then the optimal risky portfolio which you form, like that will be the market portfolio. And if a particular asset has a lower market beta, so it is good in terms of reducing its overall risk, and so an investor would be willing to add this asset towards his portfolio because it is reducing his overall risk. And one main point is like it is only a measure of how it is how adding, like how adding this stock or this asset will increase or decrease overall portfolio risk. It does not explain like other things, like whether it will increase your returns or not, whether you should invest in this or not. This decision we cannot take only on the basis of beta. For that, like we move to the capital asset pricing model. So before moving to the capital asset pricing model, first we should understand like how can we measure the beta of a particular asset or particular project. So let's suppose there is a project F. So beta of this project F with respect to market will be defined by this functional form, which is like the covariance of this project with the market divided by the variance of the overall market. Okay, so this is whenever you are given this information. So if the above term is the how this project name is co-varying with the market, and we are dividing it by the market variance. So this is the basic definition, so which says like the beta is the measure how a particular project is co-varying with the market. And beta is like the additive, like the linearly additive form. What this means, like for let's suppose like a particular firm is consisting of two different divisions, say in K and L. Okay, and these two divisions have different betas, and the company has measure of like how much wealth is invested in division K and how much is invested in division L, then by taking the weighted average of both beta of the both the divisions, you can come up with the overall firm's beta. And this is applicable on wherever you are able to like the able to divide the overall firm structure in multiple cases. It can be in the form of financing like debt and equity also. So if the debt component has different beta and equity component has different beta, then you can have a weighted average and that will give you the overall market beta. Also, like there is an example in the lecture like where like two firms get merged into one. So earlier they have different beta, and in the final merged firm they have different weightage. So you can get the weighted average and get the overall beta of the merged firm also. So once you have this beta, then following like the on top of some assumptions. So these assumptions are mentioned in the class, like the all the investors are rational, they have like there is no asymmetric information, etc., etc. These assumptions, if these assumptions are satisfied, then CAPM, what CAPM does, it provides us the prediction regarding the expected return on risky assets. So what it essentially says, like expected return of a particular asset I will be equal to the risk-free rate plus beta of that particular asset times the risk premium of the market, of the overall market. And risk premium is the expected return minus the risk-free return. So the functional form is given by this equation. So this says like this gives us a benchmark like what is the expected rate of return of a particular asset I, and in we can represent it in the pricing form also. So how do we derive this pricing form? So the s, if we have a expectation regarding the future price of a particular asset, let's suppose the expected price is q, like expected future price is q and current price is p, then we can get this p by using this formula. So here eri would be like expected price eq minus p divided by p, and if we equate it equal to this return which we get from CAPM, then we get this pricing form of capital asset pricing model. And we take some example like where this information is given and you are asked to calculate these things. Okay, now like this CAPM, what CAPM does, like if we have like the returns of a particular asset I, and if we have a return of particular asset I and we have the beta of a, we have beta of this particular asset, then we can draw it on a xy plane where on the y plane there is the asset return and on the x-axis there is beta of this particular asset. Then it gives us a like there is a linear relation between these two, and the slope of this line is the market premium. So this line which we get, we call this line as the security market line. So what is security market line? It provides us the relationship between the expected return of a particular asset and its beta. And as I said, the slope of this security market line is the risk premium of the market portfolio. Okay. So as I earlier said, this beta is the measure of the like the contribution of this asset towards the overall market risk. So in other terms, this security market line is graphing the individual asset risk premium as a function of asset risk, that is the beta. And what is so in the class there is a discussion regarding SML as well as CML as well as CL. So SML is security market line, CML is the capital market line, and CAL is the capital allocation line which we got introduced in week 8. So there is a slight difference between CML and CL. So capital market line is like it graphs the risk premium of efficient portfolio which we construct from the market, like under the assumptions of CAPM as a function of portfolio standard deviation. Okay. So, and CAL is like when we get a risky portfolio, and if we connect it to the risk-free rate, then what the line which we get, we call that the CAL, that is the capital allocation line, which we learned in VCAT. So, CML is a special case of CAL, where this risky portfolio, is consisting of the overall market portfolio. Okay. And the key point to note here is these CML and CL both are like in them we are on the y-axis or the vertical axis, the asset returns are there, and on the on the x-axis there is standard deviation is on the x-axis. But in the SML, on the y-axis there is expected return, on the x-axis there is beta of the asset. This is the key difference between these two things. And once we get this SML, then we can relate this SML towards like evaluating our projects or the investment opportunities. And how do we evaluate them? So this SML we got from the CAPM. So if we take a project's like the expected return and its beta, if we put it on that plane, if this is on the SML, that means it is like it is giving the same expected return which we got from the CAPM. So we say that this SML is, so we say that this project is fairly priced, and it has zero alpha, and we are coming to this alpha part shortly. And if this project or the investment opportunity lies above the SML, then it is underpriced and it is like the worth investing opportunity. And if it is below SML, then it is overpriced and you should not go for investing in this project. Now coming to the alpha, what is alpha? Alpha is the difference between the equilibrium and actually expected rate of return on the stock. In other words, what you are actually getting minus what the CAPM is predicting for that particular asset. That gives you the alpha. So again, in the form of alpha, if we want to evaluate a particular project, so if a project has positive alpha, that means it is underpriced. That means it is giving me more return than it is expected to give. So it is a investing project. Similarly, if a project has a negative alpha, then it is overpriced and you should not invest in such a project which has a negative alpha. If you have any doubts regarding CAPM, the concept behind it and anything, please let me know. Stop me here, and then we will move to the examples where we solve some numerical examples. Okay, so let's have a look at some examples. So for example, suppose there is a firm ABC which has an expected return of 10% and it has a beta of 2, and there is another stock XYZ which has expected return of 11.5% and beta of 3. The expected market return is 6% and the risk-free rate is 3%. Now question asked regarding like evaluating these two stocks which are worth investing, and it asks you like which stock is a better buy and what is the alpha for both the cases, and which stock you should go for purchasing. So how do we solve for this? So first thing, like we should evaluate what is the expected rate of return for ABC and XYZ according to CAPM. Okay. So what it comes out, and if the expected return which they have noted down, if that is higher than the what we are predicting from CAPM, then yes, it is worth investing. Otherwise, it is not investing. Okay. So according to CAPM, for ABC, what is the expected rate of return? That would be RF is 3%. So I have written down in the percentage terms only. So RF is 3% plus beta is 2 times expected market return, that is 6 minus 3, and if we evaluate this, that turns out to be 9. So CAPM is predicting that ABC should have 9, ABC should have expected return of 9 given this beta and given this market return. But actually this ABC is giving you expected return of 10%, that is above, like above the prediction of CAPM. So it is lying above the SML, so it is underpriced. On the other side, if we evaluate the XYZ stock in the similar fashion, so the according to CAPM, so XYZ should have expected return of RF is 3 plus 3 times, that is beta of XYZ times 6 minus 3, that turns out to be 12. So but it is expected to give you only 11.5%, so it is lying below the SMA, so it is overpriced. And as an investor's point of view, you should always going for the opportunities which you think are underpriced. So here ABC is underpriced, so ABC is a better buy. We can do the same thing by evaluating alphas and then making our decision. So if you calculate alpha for ABC, that is like what is actually expected, that is 10%, and what you are predicting from CAPM, that is 9. So alpha for ABC is +1, it has positive alpha, so it is underpriced. Similarly for XYZ, the alpha is negative 0.5, so it is overpriced. So from that calculation also, you are coming to the same conclusion, that says ABC is a better buy. Okay. Any questions, any doubts in such type of problems? Okay. Coming to the second example, it says like the risk-free rate of return is 5% and the expected return on the market portfolio is 8%. A firm considers a project that is expected to have a beta of 1.5, and if the expected IRR of the project is 10%, should it be accepted or not? So from CAPM, what we can do, like we can compute the hurdle rate, which we call hurdle rate, like the predicted expected rate of return for a project, if this is given. So if we calculate that according to CAPM for this project, so that turns out to be RF, that is 5% plus 1.5, that is the beta, times 8 minus 5, 8 is the market market return and 5 is the risk-free return. So this comes out to be 9.5%. Okay, so this hurdle rate is 9.5%, which is below the expected IRR. So what it means, like this project is like the, according to CAPM, this is like 9.5% is the expected rate of return, but actually it is like the project is expected to earn 10%, but the CAPM predicts that it is only going to earn 9.5%. Then so it is like the below the expected IRR. So actually, like the, according to CAPM, this project is going to earn 9.5 only, but your expectation is 10%, which is below your like the, so according to CAPM, it is not going to earn 10%. So this project should not be accepted in that case. Okay, so this is how we can evaluate a projects also. And coming to the pricing formula of the CAPM, so let's take an example of that also. So it says like a company share price can either be 80 or 140 in 1 year. It can either increase or decrease by same probability, and the beta of this company is 1.2. The risk-free rate of return is 5% and the expected rate of return on the market portfolio is 10%, what should be the current price of this share based on the CAPM? So the first we need to compute the expected future share price, that is like the 150% times 80 plus 50% times 140. So EQ is like 110, and we need to divide it by the expected return get from the which we get from like the CAPM formula. So if you put all these values, then like the current price, they turns out to be 99.1. And if we are given some values for the present price, let's suppose if the present price is 100 rupees, so that means this is currently overpriced. So you should not go for purchasing this share. Otherwise, you should opt for selling this. Okay, this is the way we can utilize the concept of capital asset pricing model in our in practice also. Okay, after like the learning the basics of capital asset pricing model, we move towards like the arbitrage factor models. So rates of return of a particular asset can be written as a function of various factors, and these factors are the various economic indicators it can be like, for example, in the CAPM case, this factor is the market return. Other factors can be like, if you like, it is based on your understanding, like what is the economic indicator or economic variable. If you think a particular asset's price is related to a country's GDP, then country GDP can be included in this functional form as a factor. Other things can be like the what is the prevailing interest rate in the market. Like in the India case, let's suppose if you take the repo rate, if that is you think can affect the price of this particular asset, then yes, you can include that in your this factor model. So in the class we understand about single factor models only, but like some well-known multiple factor models are like the which are given by the Fama and Friends, which we call them like the very famously we call them three factor models or the five factors models, where the factors are like defined by them in the forms of like high minus low and small minus big, etc. And like this is out of this course scope, but I am just giving you a information like where these factor models are used. These are used to like the get the gist of like the rates of return of a particular asset. Okay, and now coming to the arbitrage pricing theory, the key underlying idea behind the arbitrage pricing theory is like there should not be any arbitrage in according to the prices of according to the given asset prices. So the asset prices should follow this no arbitrage condition. So asset prices always move in the direction where all arbitrage opportunities cease to exist. So this is the underlying concept behind this arbitrage pricing theory. And if we like the write down like the expected return can be written in the form of like the some intercept plus the some coefficient times the expected return of a particular factor. Okay, and in this functional form, this expected value of this factor is termed as the price of the risk associated with the factor Fi, and which we call as the factor price also. Okay, and the CAPM is a special case of this single factor model under arbitrage pricing theory. So if we replace this factor by market return, then this turns out to be the CAPM which we learned earlier in this week. So here the questions may be in the form like you are given, let's suppose a asset is following a single factor model, and you are given the beta for this particular factor and the expected return on this factor, and if this factor expected value of this factor changes by some value, then by how much the asset the asset expected return is going to change, like similar to the CAPM only, like this much we learned in this course. So these type of questions you can expect, like some of them which are covered in the GA also. Okay, so this is the we covered only the tip of iceberg under this arbitrage pricing theory. So there is a lot of mathematics involved in like deriving the complex pricing formula for this arbitrage pricing theories, to which you may encounter in some advanced courses in the finance later on. Okay, now coming towards the end of the course, we again go back to the our the initial discussion regarding the overall markets. And as we said earlier also, our assumption was regarding the markets are perfect. And what are the assumptions under the perfect market? So in a perfect market there is no asymmetry in the information. That means all investors have access to similar information. Okay, this is the first assumption. Second assumption is there are a lot of buyers and sellers in the market. So like the presence of a particular market player is not going to affect the overall market. Okay, and he cannot influence the price. That is the basic concept behind it. Third is like there is no transaction cost. So making any transaction in the market, there is no transaction cost. And fourth one is there are no taxes. Now in this course we discussed regarding the financial markets mainly. Okay, like the share market, or mainly the share markets, and briefly about option market, like the derivatives market also. So how these assumptions are valid in this financial market? So in general, like let's suppose if we consider the exchange related trading, so all the agents have the similar kind of information, more or less. They have all the prices are listed on the exchange and they have the similar information. So we can conclude that yes, this first assumption that is satisfied for the asset markets. Also, as you know, there are a lot of investors which are willing to buy and sell. So this second assumption is also more or less satisfied. And if we take a look at the overall trading volume versus the cost that is there for each transaction, that is very low for a particular transaction. So we cannot say there is no transaction cost, but that is very minimal with respect to the volume of the transaction. And fourth one is there are no taxes. So taxes are determined by different the authorities or the regulators, which differs by country. And yes, if there is high capital gains tax, so this may distort the market. And also the professor says if any one of this assumption is violated, then this can distort the market. And if very heavily it can distort, then this market is ceased to exist. So market will not exist at all if these assumptions are not satisfied. For example, if there is one large buyer, let's suppose he kind of a monopolist kind of a person comes to the market, so he can have a very tight grip on the overall market, so he can influence all the market. So if others investors see if they have no chance of affecting the market, only they have to follow what he is saying, then yes, they will eventually exit the market, and the market will eventually cease to exist. Okay, so this was the discussion regarding like the how what we call the perfect market and what happens in case like in case these assumptions are violated. Okay, so also like if there is asymmetry in the information, so if but one agent has more information than others, then he can like the influence prices, and yes, that's how it changes the market. So the evaluation which other investors are doing, which differs from him, and he like he can either predict better or predict less. And coming to the information part, we can we have a slight discussion regarding the overall market efficiency. So there are various types of market efficiencies which are discussed under the efficient market hypothesis. But first we need to understand like what we mean when we say like a particular market is efficient. So if the market efficiency is defined in the form like the market uses all available information as well, like as like the in or like the total power, like whatever information that is there, that is consumed by the market, that is reflected in the asset prices which are there in the market. So this is the basic concept of efficient market hypothesis that says like a particular investor, he should not be able to use any available information in order to predict the future prices better than the market can. So in other words, the whatever market returns are there, those are like the if we take a look at them like in a longer run, then we would see like yes, these market returns are more or less like same or better than a particular investors. So if he's choosing some other strategies, then like he will have kind either same or less than the market return which are there. This is the basic learning from the efficient market hypothesis. And there are various forms of efficient market hypothesis that says like first one is the weak market efficiency that says like the whatever prices are there, those are reflecting all the information which is coming from the past prices. This if this is true, then we call that like markets are weakly efficient. Then weakly efficient. Second form of market efficiency is the semi-strong form of market efficiency that says like the prices are reflecting all the information which is coming from the past prices as well as all the publicly available information. And third is the strong market efficiency that says like the prices reflect all the past prices information, all publicly available information, and all the private information. Okay, if this is true, then we call markets are strongly efficient. And the perfect market is a type of strongly efficient market. And finally, like according to the efficient market hypothesis, so if markets are working well, so that means like it is nearly a efficient or a perfect market, then prices would have very little predictability. Okay, so you cannot predict what the price is going to be in future. That is the basic concept under this market efficiency. Okay, so this was the topics which we discussed in week 12 and which conclude our course also. And I think in the coming Sunday, like the I think on April 13th, you have the final exam for this course also. Am I correct?
Yes, yes.
Yeah.
Yes.
So coming to the final exam, so in the final exam, the all the all the weeks, like the whatever we learned throughout this course will be part of the final exam. But like the major focus will be on the topics which are not covered under the quizzes. That is like the the content from week 9 to 12. So the major portion will be covered by them, and some questions will be from earlier weeks also. So the ratio which we generally follow is like around 75 to 80% from the later weeks and only 20 to 25% from earlier weeks. This is the like the breakdown which we use for the final exam. And if you have any other questions regarding final exam, please let me know. And I will post this information on our Google discussion forum also. Okay. So this breakdown of like the contents which are going to be part of the final exam. Any
So the
questions?
revision session, when you have planned to take?
So for that, like in the previous term also, like I conducted a revision session for week 9 to 12 for the final exam. So what I will do, like I will post the link to that session, and I can also take like the one live session in coming week, whichever day is preferred to you. Like if any day, like the Thursday or Friday, I am
Thursday is the
I
better,
am
sir.
yeah, I am comfortable on those 2 days. Okay, and timing will be the same from 6 to 7 only on Thursday or Friday. So please let
So,
me know like which day works for you. Accordingly, like I will schedule the like
and
this
Thursday
live
is
session.
Thursday you can keep, sir, if others do not have any problem.
So I will I will post this on the our Google discussion forum, and let's see if anybody don't have any objection. Then we will have the final revision session on Thursday. Okay.
And sir,
Please go through the slides and practice some questions, and please bring your doubts in the live session so that we can have a better understanding and better prepared for the final exam.
and
Yes,
sir, will you
somebody.
change the pattern for the end term with respect to previous year?
So yeah, a little bit change maybe there, but more or less like the length will be the same. So around 35 questions will be there. So the pattern may change a bit, like but it will be like more or less the same, like the MCQs, true false, and MSQs, etc. I think the numerical answer type I think are not there this time. Only the MCQs, like multiple select questions are there, like which I think like the multiple options may be correct.
So numerical will not be there.
So numerical in the sense like those are asked in the form of MCQs and MSQs and true false.
Okay,
Okay, like similar to the quizzes only.
okay.
Okay.
Yeah, yeah.
So okay, I will like the post in the like the Google discussion forum that the live session is on Thursday, and if you have any doubts regarding the intern, please let me know. Like post it on the Google discussion forum only, or any other doubts regarding any week's content, please let me know. Okay then. Thank you for attending, and let's meet on Thursday if you have any doubts regarding any topics. Okay.
Thank you, sir. Thank you.
Thank you, sir.